Okay, hi everyone. This is going to be the problem video for chapter 13. We have what, 6 problems we're going to go through here. Okay? So the first one, let's kind of zoom in and take a look at this here. It says a company, a Swedish manufacturer of sailing yachts, that's what they produce. They have assembled the information below that pertains to two independent decision-making contexts. All right, so we have case A and we have case B. In case A, it says the company chronically has no idle capacity and the old model B100 machine is the company's constraint. Management is considering purchasing a model B300 machine to use in addition to the company's present model B100 machine. The old machine will continue to be used at capacity as before, with the new machine being used to expand production. This will increase the company's production and sales. Then it says the increase in volume will be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in the fixed manufacturing overhead. Okay, that's case A. We're looking at potentially getting a new machine here. In case B, it says the old machine is not the company's constraint, but management is considering replacing it with a new machine because of the potential savings in direct materials with the new machine. It looks like the model B100 machine would be sold. This change will have no effect on the production or sales other than some savings in direct material costs due to less waste. Okay, so we're looking at two scenarios there, reasons why we may get a new machine. It says here, copy the information below into your answer sheet and place an X in the appropriate column to indicate whether each item is relevant or irrelevant to the decision context described in case A and case B. Okay, so basically we want to go through here. We're looking at case A, case B, and I'll just draw in to make it a little bit easier, whether it's relevant or irrelevant. And again, remember the things we're looking at here is if there's going to be differential between the choices or not. Okay, so when we look at this here, right, if we go up to case A, so we'll focus on case A first, essentially what's going on here is we have no idle capacity and the old machine is our constraint. We're looking at buying a new machine to use in addition to the old machine. We'll still use the old machine with the new machine to expand production. This will basically increase our production and sales. The increase in volume will be large enough to require increase in fixed expenses and in general overhead, but not in fixed manufacturing overhead. All right, so we're really looking at what differs from this choice. In other words, the sales revenue, is that going to change whether we get the new machine or not in given case A circumstances? So that one, yeah, that will change, right? That's going to be a relevant cost between them. Same with, if we read the facts there, our direct materials, our direct labor, and our variable manufacturing overhead. That will also change if we go on this. Now, the idea here, right, with our machine that we have, our B100, the one we exist, that's going to be depreciated either which way, right? So that's not going to change between alternatives. So that's going to be an irrelevant cost, as well as what we could sell it for. We're going to use it either way. It's not going to change. However, here, right, the market value, the cost of the new machine, so the new machine's the 300, the old machine's the 100, that does change between alternatives, right? In one alternative we buy it, and the other we don't. It says specifically in the facts that if we buy it up here, so if we go up, right, it says the change will have no effect on production or sales other than some savings in direct material costs due to less waste. Okay? Oh, that's in case B, I'm sorry. Up here it says in case A. The increase in volume would be large enough to acquire, so we increase fixed expenses in general administrative, but not in fixed manufacturing overhead. Okay, so this fixed manufacturing overhead is going to remain the same under each choices, but our variable selling expenses, our fixed selling expenses, and our general administrative overhead, those all change because of alternatives. You're really just looking, if I do A, right, if I buy this new machine, what will change between these? These costs over here, they're kind of like sunk costs. They're going to happen either way, regardless of what decision we make. We should ignore them. They're irrelevant costs. All right, let's look here at case B. All right, it says the old machine, the 100, is not the constraint. Management's considering replacing it with the 300 because of potential savings in direct materials. The old machine would be sold. The change will have no effect on production or sales, okay, other than some savings in direct materials or cost. All right, so sales revenue, that's going to be an irrelevant cost here. They said there's going to have no effect on it, right? But direct materials, they did say it would affect it. Looking at the facts up there, let's see here the machine, because of some potential savings in direct materials with the new machine. So we accounted for that. No effect on production or sales. Okay, so then there's no effect here for our direct labor, for our variable manufacturing overhead, as well as, right, the depreciation on the old one. In that case, if we look at it here, right, we're keeping it and then we're going to sell it, I guess, at the end of the year. So we'll still depreciate it the same way. It'll have the same book value and we could sell it for the same price, the old machine. In this way, right, oh, I'm sorry, we got to change that here, these last two. Sorry, it's a little bit hard here. What does change, right, is the disposal value of the machine. In other words, we will sell the old machine, and then obviously the new machine here we would buy, right? So with that, we're kind of right here on it. So let's go down and move down in the items here with the last few items. All of these are going to remain the same regardless of the choice, right? Our fixed, variable, fixed, general. In short, right, the only things that are really changing, right? This one tends to be, like if you compare these two, the first one, there tends to be a lot of change and a lot of relevant costs. Here, there tends to be not as much change, so more irrelevant costs. The only things that change between it, if we look at it, is some savings in direct materials, which we accounted for. The fact that we would sell the old machine, right, right here. The fact that we would buy a new machine. Everything else in that scenario is the same. Okay? Let's move on here to exercise 13.2. Okay, so if we look at it, it says the Regal Cycle Company manufactures 3 types of bikes. Looks like we have a dirt bike. All right, dirt bike. We have a mountain bike. And then we have a racing bike, okay? Data on the sales and expenses for the past quarter are as follows. So they're giving us some information here. Looks like sales minus variable costs, we get our contribution margin. Back out the fixed expenses, gets us our net operating income. Now, it says at the bottom here, it says management is concerned about the continued losses. All right, so the continued losses shown by the racing bikes and wants a recommendation as to whether or not the line should be discontinued. The special equipment used to produce the racing bikes has no residual value and does not wear out. All right, so they're looking at the racing bike line here. and they're saying, hey, we're at a loss, right? Should we keep or drop that segment? Let me get that out of the road there. All right, so it says here they want to know what is the financial advantage or disadvantage per quarter of discontinuing the racing bikes. 2, it says should the company or should the production and sale of the racing bikes be discontinued? And then 3, prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines. All right, so this is like kind of a mouthful here. Let's take it one at a time. First one says, can you please tell us what is the financial advantage or disadvantage of discontinuing the racing bike line? So let's do that up here. Right, so what we're going to look at here is the loss contribution margin, right? In this case, it looks like it's 27,000. Right, so that would be lost if we got rid of the line. And we have to compare that with our fixed costs that can be avoided. Okay, and in that case, going through, let's see here if we go through on these. So it says fixed costs that can be avoided. It looks like our advertising is capable of that. And then our salaries of our product line managers, those are also going to be avoidable costs there. In other words, we can get rid of those. So we will have our advertising, and then we'll have our salary of our product manager. All right, so that will be what, 6,000 from over there. Then we'll have what, our 10,000 from that guy, so that's going to get us 16. So in this case, right, if we take the 27 plus the 6 plus the 10, we're looking at a financial disadvantage of $11,000. And the idea here is with the depreciation and the other items, the depreciation of the special equipment, right? So like that cost right there, that's a sunk cost, right? We're not going to be relevant to the decision, so we're going to ignore it. We've already bought those items, so we're going to have that either way. And then it says the common costs are allocated and will continue regardless whether or not the racing bikes are discontinued. Thus, they are also ignored. So in other words, ignore depreciation, that's a sunk cost. Ignore the common fixed expenses, both of those not relevant to the decision. So when we look at just the relevant decision here, right, the loss contribution margin compared to our avoidable fixed costs, we're looking at a financial disadvantage of $11,000. All right, it says, should the production of racing bikes be discontinued? Well, no, right? The production and sale of the racing bikes should not be discontinued. In other words, getting rid of it, right, we're going to be at a financial disadvantage in that case of discontinuing the line. In other words, getting rid of it, we're going to lose effectively $11,000. You don't want to do that, right? You should then keep it. All right, so we've done 1, we've done 2, and then 3, it says, can you please prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability? Okay, so this is a little bit of an item here. We're going to have to draw from some of those, but we can do this. So the segmented report, basically what we're going to do here, we're going to eliminate the allocation of the common fixed expenses. We've looked at this a little bit in chapter 6, so if we break this out, right, we'll have, let's just say total, we'll have our dirt bike line, we'll have our mountain bike line, and then we'll have our racing bike line. Alright, I think I made that, let's see here, yellow, green, and then blue. So what we'll do here is, right, we'll start with our sales, and we have 300,000, right? We'll break that out just like they have it. 90,000, 150,000, and 60,000, okay? Then we'll take our variable manufacturing and selling expenses, right? Our variable manufacturing and selling expenses. In total here, if we go over, right, that's again just what's over there. We got the 120, we got the 27,000, we got the 60,000, we got the 33,000. That's going to get us our contribution margin. Alright, so we can just formula this here. 180, carry over the formula. Looking at 63, 90, and 27. Then what we got to do here, right, this is kind of where it starts to differ, is we have to look at our traceable fixed expenses. Right, so in this case, right, we're going to have our advertising, our depreciation of special equipment. We're going to have our salaries of the production line manager. And basically what we then would do is, like, we're going to ignore these allocated common fixed expenses. All right, so we're looking at just traceable fixed expenses, not in any way allocated common fixed expenses. So advertising here, we're looking at what, 30,000. A lot of this we're just snagging right from over there. 23,000 and then 35,000. You break it out over here. We're looking at 10, 14, 6,000. 9,000, 8,000. Again, I'm just snagging the information over there to the left. And that will get us our total traceable fixed expenses, right? You add those up. Right, we're looking at 88, carry the formula across, 28, 36, 24. Okay, then what we'll do is we'll have our product line segment margin, right? And what we'll do here, let's see, we're gonna take 180 minus the 88, we're looking at 92. And we'll carry that formula across, right? 35, 54, 3. And then when you do the common fixed expenses, you'll do it on this side, right? You'll put the $60,000 here, and that will get you your net operating income of 32, but we're not doing that across the board, right? We're just doing a segmented contribution margin there, looking at it from each product line, the 35, the 54, the 3. It's not really as fair to put those common fixed expenses. So again, what did we do here in 3? They said they want a properly formatted segmented income statement. Okay, so in the segmented income statement, we took the allocated common fixed expenses, put it over here, but we didn't attribute it to each of these guys here, right? And then what we did in addition to that, to moving the common fixed expenses down, we did a product line segment margin, for each line, right? So 35, 54, and 3. All right, let's look at this guy here. So it says Troy Engines Limited. Looks like they manufacture a variety of engines for use in heavy equipment. The company has always produced all of the necessary parts for its engines, including all of the carburetors. An outside supplier is offered to sell one of the type of carburetors to Troy Engines for a cost of $35 per unit. Okay, so it looks like they could buy it from an outside supplier for $35. So we're basically comparing here. They have produced it. Should we make it or should we buy it? And to evaluate this offer, it looks like they've gathered the following information relating to its own cost of producing it. Okay, so make versus buy decision. And the requirements here, what they want us to do, it says, assuming the company has no alternative use for the facilities that are now being used to produce the carburetors, what would be the financial advantage or disadvantage of buying the 15,000 carburetors from an outside supplier? Okay, so let's take this over here, right? And we will do it on a per unit differential cost basis. And in this column, we'll have make. In this column, we'll have buy. All right, and let's see here. What's going on? The cost of buying $15,000 units. All right, so we'll do it on an individual per unit basis, and then we'll do it for the total cost of the 15,000 units. And again, let's have make, buy. Okay. All right, so let's look at some of these costs, right? So I'm going to add this, zoom out a little bit. All right, so the first one here would be the cost of if we purchase it, right? Cost of purchase. All right, so they're telling us 35 bucks, right, if we bought it. And what we'll do here is the 35 times the 15,000 units, right? So 35 bucks would cost us 525,000. Then what we got to compare and we got to start looking at is our direct materials, our direct labor, our variable manufacturing overhead for that point if we make it, right? So that's 14 bucks, 10 bucks, and 3 bucks. Right? And again, for these guys right here, we got to multiply it. We got to figure out what it would cost in total to make all 15,000. Okay. Now, it also says we have some fixed manufacturing overhead that's traceable and some fixed manufacturing overhead that is common. Okay, so we have fixed manufacturing overhead that's traceable, fixed manufacturing overhead that's common. And the idea with this is, right, they're giving us 6 here, but they have a little asterisk to it. And it says 1/3. So 1/3 of 6 is 2. That's where we're going to get this number. Maybe I'll write it here. So 1/3 of supervisor salaries, 2, right, which is 6 times 1/3, the 6 right here. Is supervisor salaries. 2/3 is depreciation of special equipment. Okay, so here's the idea with it, right? Only the supervisor salaries, only the two, right? The supervisor salaries is going to be avoided if the carburetors are purchased. The remaining book value of the special equipment, that's a sunk cost. So the depreciation expense, we're going to ignore it, right? So that's ignored. But that, we're going to consider the 2, right? So we're going to put 2 there because that's the relevant cost. And we'll multiply it times the 15,000. And then the idea here with those common costs, we're going to ignore those, right? Those aren't going to be in the analysis. So we're going to ignore those. And with that, right, if we were to then sum it, right, and figure out our total costs, right, so if we do the sum right here of these guys, let me draw a little line on this. So we have 29, 35, 435, 525. Okay, so the idea with this is we're going to have a financial disadvantage. In other words, if we take the 29 to make, but we could buy it for 35, the idea with this is, it says here, right, what would be the financial advantage or disadvantage of buying it? Well, if we bought it, right, we're going to spend $6 more. So that's going to be the financial disadvantage of $6. If we take that at kind of the macro level of the 15,000, it's going to be 90,000 in total. In short, right, what we should do here, given these facts, is we should make it. It's cheaper to make it when we consider the relevant cost than it is to buy it. At first, you might say, hey, it's 42, but we could buy it for 35. Well, that's not an accurate analysis. That 42 has kind of some inflated numbers to it, some non-relevant costs. When we back out those non-relevant costs and we get to just the relevant cost, we see that it actually makes sense in that case to make it instead of buy it. All right, 3 here, it says that suppose that if carburetors were purchased, they could use the freed capacity to launch a new product. The segment margin of the new product would be $150,000 per year. Given this new assumption, what would be the financial advantage or disadvantage of buying the 15,000 carburetors from an outside supplier? Okay, so now what we got to do, right, is we have to consider the opportunity cost, right? So we're going to have the cost of purchasing, and let's make a make and buy column. So if we buy it, right, the all-in cost of purchasing we'll get from up here, $525. The cost of making it, right, the all-in number there, we get from up there, $435. But here's the deal with it. This is what changes the analysis here. We have an opportunity cost. If we make it, we miss out on $150,000 that we could have used that space for, right? So if we were to then figure out our total cost, right, it's $585 versus $525, right? In this case, there's going to be a financial advantage to buy, right? In other words, if we took the 585 minus 525, this one is cheaper. When you look at the relevant costs, it's cheaper to buy it here. In this one, up here, it's cheaper to make it, But when you change the facts and you have the opportunity cost involved, it changes the outcome, right? So for 4, given the new assumption of the opportunity cost, the company should accept the offer and purchase the carburetors from the outside supplier. So it's just showing you a setup there of, in all of these analyses, right, we got to first bifurcate what's relevant versus what's non-relevant, have the numbers play out, compare the financial advantage or disadvantage. All right, let's look at 13.4, special order decision. It says a jeweler, they manufacture and sell a gold bracelet for $189.95. The company's accounting system says that the unit product cost for the bracelet is $1.49, shown below. All right, so we sell it for $190 pretty much, and it costs us $149 to make. It says the members of a wedding party have approached. So this is basically our normal setup up here. But then down here, we're getting a request for a special order, right? So let's see what the request is down here. It says the members of a wedding party have approached the jewelry company. They want to buy 20 of the gold bracelets for $170. And it looks like the members of the wedding party would like special, it looks like an item applied to the bracelet, so that's what's making it a special order. And that would increase the cost of the bracelet by $2, right? Because we're going to increase our direct materials. They would also have to buy a special tool for $250, and the special tool would have no other use after the fact. All right, so it says to analyze this special order opportunity, they've determined that most of its manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. However, $4 of the overhead is variable with respect to the number of bracelets produced. Okay. And it says the company also believes that accepting this order would have no effect on its ability to produce and sell jewelry to other customers. Furthermore, the company could fulfill the wedding party's order using its existing manufacturing capacity. All right, so that's a mouthful of words here. Let's see what they're asking. What's the financial advantage or disadvantage of accepting the special order from the wedding party? And it says, should the company accept the special order? All right, so with special orders, right, we have to be aware here that only the incremental costs and benefits are relevant. And in particular, only the variable manufacturing overhead and the cost of the special tool are relevant overhead costs in the situation. The other manufacturing overhead costs are fixed and they're not going to be affected by the decision. Okay, so in this way, and let me kind of zoom out a little bit. We're going to have, let's have, on a per unit basis, and then we're going to have to look at it for the 20 bracelets, like the total cost for the special order. So first thing we're going to look at is the incremental revenue, right? They're telling us here, let's see, it looks like if we do this special order, we'll sell each one for $169.95, right? If we take that amount times 20, we're looking at roughly $3,399 if we take it. All right, incremental revenue, bam, we're done. Let's look now at our incremental costs. And this one, that's kind of a header. We have to look at our variable costs and then our fixed costs. Okay, so our variable costs here, we'll have our direct material, we'll have our direct labor, and let me move this in just to make it a little bit easier to digest, right? We'll have our direct materials, we'll have our direct labor. We'll have our variable manufacturing overhead. And then we'll have that special tool, right? The tool that we got to buy from it. So our direct materials, that'll be 84 bucks. Our direct labor is 45 bucks. Our variable manufacturing overhead, it says, however, $4 of the overhead is variable. Okay, so of this overhead right here, 4 is variable that we got to account for. And then the special tool for 250 bucks, or, oh, I'm sorry here. It's not the special tool. It's the special, I can't pronounce that word. I don't know what it means because I'm not a jeweler expert. It's a type of direct material on there. So I'm just going to put special direct material. It's this guy right here. I don't know how to pronounce that. But essentially, we're going to have $2 on top of it in direct materials. So for every new bracelet we make, the 84 that are normal plus 2 on top. They're variable. So we'll take that times the 20 units, carry the formula down, okay? That will get us, keep moving that fixed cost down here. Right, that'll get us our total variable costs. Sum that, $1.35. Add those up, 2,700. All right, now with our fixed cost, we're going to have the special tool, right? That's like a one-time purchase for 250 bucks. So doesn't really have a per unit item there. For all 20, it's a flat 250 bucks, a fixed cost. So our total incremental costs, right? That's going to be the combination of our variable costs plus our special tool, right? $29.50. So basically in this case, the financial advantage, right? We're going to take the incremental revenue right here minus the incremental cost. In short, this is profitable. If we accept this special order, we're going to make $449. In other words, for number 2 there, should we accept the special order? Even though the price for the special order is below the company's regular price for an item, so maybe you look at this originally and you say, look, we normally sell it for $190. Why would we take this on for $170? Even though that's the case, the company would be better off accepting the order. The conclusion would not necessarily follow, however, if the special order affected the regular selling price of the bracelets or if it required the use of a constrained resource. So if there were other factors at play that could change this outcome, but based on these facts and these assumptions, hey, accept it, it's profitable, something is better than nothing, you'll make money on this deal. That is to say, the incremental revenue will exceed the incremental costs. All right, let's look at exercise 13.5 here. So we have a luggage company. They make high-end luggage for sports equipment. Data concerning 3 of the company's popular models appear below. All right, so they have a ski guard. They have a golf guard. And then they have a fishing guard. And it looks like it must be hard-sided luggage for sports equipment. Okay, so they make, I guess, luggage that carries your skis, luggage that carries your golf clubs, luggage that carries your fishing clubs. Now, for one here, it says, if we assume the total, and they're giving us some information, right? What we sell each one for, the variable cost per unit, And then it looks like we're looking at the plastic injection molding machine processing time required. So we have a molding machine. This guy takes 2 minutes on the machine. That guy takes 5. That one takes 4. And the pounds of plastic pellets per use are 7, 4, and 8. Okay, so basically we use 7 pounds of plastic pellets. We put it in the injection machine for 2 minutes. It pops out a ski guard that we can sell for $200 that cost us variable costs of 60. Now, the first one says if we assume that the total time available on the plastic injection molding machine is the constraint, right? So that's what's holding us up, right? The time on the injection, the plastic machine is the constraint. How much of the contribution margin per minute of the constrained resource is earned by each product? Okay, so what we got to do here is break this out a little bit, right? We're going to have, and let me zoom out here. So we'll have the ski item, right? The ski luggage, the golf luggage, and the fishing luggage. All right, and we can look here. First off, we got to find out the contribution margin per unit, which will basically just be the selling price minus the variable cost, right? And we just take this information from over there, right? 200, 300, 255, what we sell it for. Looks like it's 60, 140, and 55. Right, so the contribution margin on a per unit basis, $1.40, carry that formula over, $1.60, 200. Now what we got to do in order to figure out the contribution margin per unit of constrained resource is we got to look at basically the time it uses on the machine. Right, so it says here it's 2 minutes, 5 minutes, and 4 minutes. Right, so we're going to take this contribution margin and basically per unit of constrained resource, right, the time on the machine, right, so that's the constrained resource right there. So if we take the 140 divided by 2, it's $70 per minute, right? 32 per minute, 50 per minute, right? So that's the idea here when they want us to figure out the contribution margin per constrained resource. And it says, which product offers the most profitable use of the plastic injection machine? In other words, if you had to pick these, which one would you pick to produce? Well, the idea for this is the winner here is going to be the ski guard, right, for 2. Right? In other words, it's the most profitable per minute. This is the biggest item. 70 is the highest. If you looked at these originally, right, you might say that, hey, this guy would win because it's the biggest. However, right, it takes up 4 minutes on the machine. When you look at what you can churn out in light of the contribution margin, the winner here is going to be the ski luggage. So 2, it's going to be the ski luggage is the winner. All right, 3. Let's look at 3. It says, if we assume that a severe shortage of plastic pellets has required the company to cut back its production so much that its new constraint has become the total available pounds of plastic, how much contribution margin of the constrained resource is earned by each product? And then for 4, it says, in light of this, which one should we pick? All right, so what we can do here, basically they're just changing what is the constrained resource. So some of this we can snag from up here. So first off, we can keep this, right, because that's the same. But what we're changing here is we're not using the time on the machine anymore as the constrained resource. Instead, the resource is these pounds of plastic pellets. So pounds of plastic pellets. So in that case, right, it looks like it's 7, 4, and 8, right? So in that case, right, the contribution margin in light of the new constrained resource, the plastic pounds, you can see in this case that the best one to pick here would be the golf luggage, right? That would be the most profitable. Okay, so it's just changing it. It's showing you, again, another setup. You might think that this guy is the most profitable originally, 200. That's wrong, right? When you look at it in light of the constrained resource down here, that guy's the winner, the golf luggage. All right, 5, it says, which product has the largest contribution margin per unit? Why wouldn't this product be the most profitable use of the constrained resource in either case? So that's what we just said, right? It looks like this one's the best originally, but when you really pick the winner in light of the constrained resource, it's not the best, right? It ends up actually being second place here, and down here it's second place as well. So that's just what it's saying. Don't get tricked by appearances. All right, last problem here. It says Dorsey Company, they manufacture 3 products from a common input and a joint processing operation. Joint processing costs up to the split-off point are $350,000. Okay, so it looks like they have 3 products they make. That's the split-off point. Up to there, it costs $350,000 per quarter. For financial reporting purposes, the company allocates these costs to the joint products on the basis of their relative sales value at the split-off point. Unit selling prices and total outputs at the split-off point are as follows. Right, so it looks like they can make product A, B, and C. What they can sell it for, and the quarterly output of it. Now, here's the thing. It says each product can be processed further, right? So we could sell it as is, or we could process it further after the split-off point. Now, it says additional processing requires no special facilities. The additional processing costs and unit selling price are given below. So in other words, these additional costs, if we were to throw that money into it, would be that, and then we could sell it over here, the additional selling price there. All right, so they're saying basically, look, we're in it for $350. You could sell A, B, or C from that. Alternatively, you could process A, B, and C further and sell it for that. They want to know here, right? What is your financial advantage or disadvantage of further processing each of the 3 types of products beyond the split-off point? And it says, based on your analysis, which product or products should be sold at the split-off point, and which products or products should be processed further. Okay, so, oops, we're a little too far out there now. All right, so let's look at this here, right? So we will have, I'm gonna zoom in here a little bit. Product A, B, and C. Okay, now first thing we gotta look at in this is basically the selling price after further processing. Right, so if we go down here, it's 20, 13, and 32. Right, 20, 13, 32. And then we got to look at basically the selling price at the split-off point, what we could sell it for up here, right? So the 16, the 8, and the 25. The difference between those two is going to be our incremental revenue per pound or gallon, right? So we do the 20 minus the 16, 4, carry that formula across, right? In other words, our incremental revenue from processing them further will be that amount. Now, what we got to look at, well, that's on a per unit basis. So let's then do times how many are in demand here, right? So we have our total pounds or gallons. So it looks like 15, 20, and 4, right? So we have 15,000, 20,000, 4,000. This will give us our total incremental revenue, right? It's basically the $4 per unit times how many we're going to sell from it. So 60,000, 100,000, and 28,000. It's great. Now what we got to do is look at our total incremental processing costs. Right, so total incremental costs. In other words, they're saying right here 63, 80, and 36. 63, 80,000, 36,000. Now, in this case, right, we'll have a financial advantage, or if it's negative, a disadvantage for each one. Right, so we'll take the 60 minus the 63, 3,000, so that's a disadvantage. 20,000 and negative 8,000. So what this is basically saying is when you look at the incremental revenue minus the incremental costs, the only one that we should process further, right, is this guy, right? It's profitable. So we should process further. These two, right, the negative 3,000 and the negative 8,000, we should basically just sell. We're better off selling at the split off point. In other words, the incremental revenue from further processing it does not exceed the incremental cost of doing that. So we're better off for what? A and C, sell here. B, process it further and sell it there. So that's some examples here for what's going on. You can look at these. Like I said, it's one of those things you kind of have to play with the numbers for a little bit, run through the scenarios. The multiple choice, the optional ones are good to help you out with it. But with that, I'm going to end the video here, and we'll see you in the next lecture.